Good afternoon, ladies and gentlemen. This is a FENG Special Interest Group meeting for the international community. My name is John Crystal. Today we have Gordon Lin from Cabrillo Advisors to talk to us about 409 valuations. I know this is an interesting subject for a number of you. So welcome, Gordon, and thank you for standing in to your buddy at very short notice. And I'll hand over to you now to give the presentation. We'll take questions at the end, but you are welcome to log them in the chat box.
Sounds good, John. Thank you very much for the introduction. So I'll go ahead and share screen. All right. So do you guys see my presentation?
Not yet.
Let me know when you have it in front of you.
You're good to go.
Great.
Yeah,
Thank you.
yeah.
Great. All right. So yeah, again, my name is Gordon Lin. I'm a senior director at Cabrillo Advisors. So just a quick intro about Cabrillo Advisors. We're a middle market valuation firm, and we do valuation pretty much for every purpose. So obviously the 409A, that would be for tax reporting or financial reporting. But we also do valuation for fairness opinions. So that's when companies make an acquisition, and if it's big enough or significant enough, then a fairness opinion is required. So that would be a transaction opinion type of analysis. We also do valuation for internal planning purposes when companies wants to raise equity, or if the owner wants to sell a company, or if they want to buy back shares. Something we'll be able to do. We do a lot of financial reporting valuation, so that would be for mergers and acquisition, purchase price allocation. So that's also intangible assets, IPs, goodwill impairment type of analysis. And a lot of tax reporting. So for example, in the USA, everyone has a $12 million gift exemption, but that'll sunset in 2025. So a lot of what we're doing now is actually estate planning, gifting type of valuation, because if you don't use it, you lose it. So a lot of wealthy entrepreneurs, they're trying to gift the shares and utilize this $12 million exemption. And since my understanding is there are actually a lot of people in Europe on this Zoom call. We actually do a lot of valuations for a lot of our international clients. And a lot of it is for tax reporting purposes. So a lot of companies, they want to move their IPs to, say, Switzerland for tax purposes. We'll also be able to value the IP. And also, the 409A is a US IRS tax code. So strictly speaking, if it's a foreign company in Europe, they don't need to follow the 409A rules. But if the foreign company has US employees or people with US green cards, then they actually need a 409A too, because the employee still needs to follow IRS rules. So just a little bit of tidbit about why 409A is important, because it does a real impact on tax, and there could be penalties if companies don't get proper 409A. But just a quick overview of just kind of interesting valuations that we've done. Some of the companies you might recognize. So DraftKings, it's a big online gambling company that we advised all the way from their inception through IPO, and now it's a multi-billion-dollar company. Wish, it's a internet retail company. They went public a few years ago, but stock price is not doing so hot, but still a very well-known company. Roy Event Sciences, the founder was actually running for the president of the United States. He dropped out. And then another one, interesting one, Grindr. So when we got hired back in 2015, 2016, people were always joking about Grindr, but now it's also a multi-billion-dollar public company. But yeah, so regarding 409, again, it's a IRS tax code, and it's to satisfy federal tax regulation. And essentially, if a company wants to issue, private companies, if I may add, if they want to issue stock compensation, then they need a 409 to set a strike price. And that's important because a 409 essentially allows a company to defer the compensation. So let's say if a company's the share value is $10 a share, and as long as the company issues the option with a strike price of $10 or above, then the compensation is essentially deferred. But if the company issues the strike price at $5 when the per share value is 10, then that means there is a $5 in compensation that the employee needs to pay tax on. So there's actually real tax consequences for the employees and actually for the companies too. And there could be real punitive damages if the company does not follow these 409A rules. And that's why it's important to get these 409A done properly. So I talked about the exercise price. Again, it needs to be issued at or above fair market value. If you issue the strike price at below fair market value, then there's a tax consequence for the employee right away. Also, a 409 is usually good for 12 months. So you need to update a 409 at least on an annual basis. But a lot of times you actually need to update a 409 if there's a significant milestone or significant event. So for example, if a company raises a new round of equity, or if there's a transaction, the company acquires a company, or you hit certain milestones. For example, if you get an FDA approval, then you'll probably need a new 409A. But the 409A does provide safe harbor to the board. So again, it's just something you want to make sure you check the box and so that you don't run into issues with the IRS or auditors in the future. And a lot of time, the 409s actually get reviewed by the auditors because it needs to be companies, they need to expense their stock compensation, and that does go through the P&L. So that also needs to be reviewed by your auditors. And if you are getting closer to a liquidity event, so maybe an IPO or getting acquired, or actually IPO, then the SEC will also review the 409A. And that's why it's important that, when you look for a 409A provider, you want someone that has the experience dealing with the auditors. And we've got plenty of experience dealing with the big four, Deloitte, KPMG, EY, actually big A, so Marcon, BDO. So we're very familiar with what they are looking for. And some of the drivers on the valuation, as a matter of fact, in general, when we value a company, well, the three main drivers are the growth, profitability, and size. The growth and EBITDA margins, assuming you have good growth and good EBITDA margins, you'll in general have higher multiples. And size as well. So if you have a bigger company, in general, you'll get a size multiple expansion. As a matter of fact, there are private equity firms, their whole thesis is to acquire a bunch of small companies and roll them into a big company to realize the multiple expansion. And the premise is a big company, they'll usually be more diversified. They'll have a deeper bench management team, better access to capital market, and therefore a higher multiple. So I talked about the growth and margin and also the market factors. So a lot of times we do annual valuation for our clients, and we have companies that have the same growth every year, same EBITDA margin every year, but maybe multiples will continue to go up just because market is hot, right? So from 2020 to 2022, everyone's multiples going up, even if there's no changes to their operations. And then 2023, everyone's multiples down, even if they are still doing what they're supposed to do. It's just the market. And then, of course, the discount rates if we are using the income approach. A few other important factors to consider would be a new round of equity. So if you issue a new round of equity, that usually means that there's going to be an impact on the valuation. If you make an acquisition, new contracts, significant events, which we talked about earlier, those would have definitely an impact on the valuation. Changes to the business model. I remember in 2018 and 2019, a lot of our clients pivoted into cryptocurrency. So that would also have an impact on the valuation. So some of the methodologies that we use to value. So for an earlier stage company, it's probably going to be a cost approach. So how much you put in is, probably a pretty good indication of how much the company is worth. We'll usually still need to consider some type of return that any investors expect. But usually asset approach is relatively straightforward. How much you put in and multiply by the percentage of accretion. And then the market approach, I think everyone is familiar with the EPS type of concept. So that would be earnings per share. But in reality, we usually use EBITDA multiple or revenue multiple. And then one approach that we use a lot is similar transactions that includes mergers and acquisitions, but also backs off. The simplest form of backs off is if a company has 100 shares and they sell a share for $1, then that implies the company is worth $100. But that's the simplest form of backs off. Usually it's more complicated. Usually we have companies that issue preferred shares. And these preferred shares, they have liquidation preference or they have all these rights and privileges. So a preferred share that's sold for $1 a share would mean that a common is probably worth a lot less. It could be worth only 70 cents or 60 cents because, preferred shares, they have liquidation preference and the additional rights. And the final approach is the income approach. We usually use the DCF method. So it's the concept of a bird in a hand is worth more than two in a bush. So the cash flow that you'll receive today is going to be worth more than the cash flow that you'll receive tomorrow or next week. So some of the major levers for the valuation. So under the asset approach, it's usually the percentage of productive expenditures. So just because you put in $1 million doesn't mean an entire $1 million is accretive, right? Sometimes maybe 50% of it went down a rabbit hole, or sometimes you think every dollar is accretive. The market approach, so it's market multiples, just like I said earlier. Sometimes when the market is up, the multiples just go up, even if the company is not doing anything new, right? It'll just have a high multiple. And then the discounted cash flow method, definitely the forecast has a lot to do with the impact of the DCF, the nature of the forecast, whether it's aggressive, conservative, middle of the road. And then finally, the discount rate or the weighted average cost of capital. So that's the input that we use to discount the cash flow. So here's just a quick overview of business valuation. So we talked about the various approaches. So you could have the market approach, the DCF method, the income approach, and there should be an asset approach as well. And that'll get us to the enterprise value. And the definition of equity value is enterprise value minus debt plus cash. That'll give you the equity value. And the equity value is also the market cap. So usually when we talk about, when people talk about the valuation of a company like Apple, right, or Microsoft, $2 trillion company, that is the market cap, and it's also like equity value. So after we've determined the equity value, then we need to determine the per share value. As a matter of fact, that's the premise of the 409A valuation, is the per share value, because companies, they issue options on a per share basis. So we need to determine the per share value. And if it's a company with only common capital structure, then it's very simple. If, it's just equity value divided by the total shares of common outstanding. But a lot of times, the companies that we deal with, they usually have more complicated capital structure. So a company with Series A, Series B, Series C, or junior securities, that would be common and options. I mean, they all have different participation. So we need to structure an OPM model, option pricing model. So we'll structure the waterfall and we'll include the Black-Scholes in the model in order to properly allocate the per share value. And the thesis is just because a junior security is out of the money, right? So if you think of an option or common share, they might not get paid if the company is sold today. But sometimes, but there's still option value. As a matter of fact, that's why companies they need to use ASC 718. So they need to expense their stock option as compensation, even if it's not in the money, because there's still option value. And then the most complicated allocation method is P-WARM. It's just a fancy term for a multi-scenario type of analysis. So for example, if a company is about to go public, then the preferred shares, 99% of the time, they just convert into common. So then that's a different allocation versus if the company goes into liquidation, then in that case, the preferred, they get their preference. And sometimes there might be a different participation under a merger scenario. So usually when a company is approaching an IPO, then we need to use this P-WARM method. And some of the levers that would drive the allocation to the value of the common is volatility, time to liquidity, and then probability. And also just want to make sure everyone understands Black-Scholes, just in case. So Black-Scholes is just a methodology to value options, and that's pretty much the prescribed methodology that auditors, SEC, everyone wants to see the Black-Scholes. And there are different stages of a company from early stage to going public. So usually for earlier stage company, it's probably backs off cost approach type of analysis. But as you progress towards an IPO, it's usually going to be more complicated, more traditional valuation methods, the DCF market, and it's probably a P1 type of analysis versus just a regular current value method or the regular option pricing model. And also a mature company, they probably have more complicated financial statements as opposed to an earlier stage company. They might not even have revenue. So there are different stages and we would apply different methods. So there's not one solution. It's usually every valuation is going to be different. So key factors that will influence the valuation, and I think it's important to note that usually companies, they want a lower indication for the 409A because they want to incentivize the employees. So usually a lower indication is preferred. And so the discount for lack of marketability is definitely helps with reducing the per share value. So the premise of this discount for lack of marketability is if you own a share of Apple, you can sell that share of Apple anytime you want. So there's plenty of marketability. As opposed to if you own a share of a privately held company, you don't have marketability. So there's a discount that we apply to. And that discount usually ranges from 5 to 35%, maybe 40%. 5% is really low. It's usually right before an IPO, as opposed to 40%, maybe 3 to 5 years before an IPO. And the methods that we use to determine a DLOM, the primary method is also Black-Scholes driven. So let's say you own a share of a private company, right? But if you also have a put option, and a put option is just an option that allows you to sell the share back to the company. So if you also have a put option, then you essentially have marketability. So, but how much would that share of put option cost? So that's why we also run a discount or option Black-Scholes option model under the DLOM analysis to determine, the theoretical put option, how much it'll cost, and the implied discount for lack of marketability. But we also review a bunch of studies. So it's not just, using a Black-Scholes. There are also market evidence on how privately shares are traded. In terms of the 409 process, for a Cabrillo advisor, it usually takes us about 2 to 3 weeks. And usually we'll definitely want to review the financial statements. We'll want to review the forecast, understand the cap table, any fundraising events. And then we'll schedule a due diligence call and make sure we really understand the company. And then we'll issue a draft. And then and before we put a final stamp on it, we'll make sure to have discussions with the management team So make sure everyone, is satisfied with the analysis. But if you have any need for fast turnaround, let us know. We work with our clients. We could usually get it done within a week as long as we have the information we need. So what to look for in a provider. So that's an easy one. You should just hire Cabrillo advisors. But jokes aside, I think it's important to hire someone that actually understand, the 409 and the audit review process. Because again, it does have real dollar consequences, and it could impact your financial reporting. It could impact your IPO process, because everyone needs to review this. So it's important to find someone that has the experience, that knows what the auditors are looking for. Our career advisors, we do about 700 to 800 valuations per year, and I would say about half of those are 409As. So we're definitely very familiar. We've very familiar with what auditors want to see. We deal with the SEC before, so we definitely understand how it's done. And also, just to quickly add, at Cabrillo Advisors, we are industry agnostic. So because of our location in San Diego, though, we tend to have a lot of life sciences clients. As a matter of fact, I myself, I lead Cabrillo Advisors life sciences practice. But in general, industry agnostic, whether you're in tech, whether you're manufacturing, aerospace, chances are we've done valuation in your space. So definitely something we'll be able to assist you with. And again, just what to look for in a provider. And I actually want to use this opportunity to talk about software type of valuation. So, and some of you might already know. So there's Carta, right? So the Carta is essentially you go to their website and you plug in the numbers, and they'll spit out a price. And the best example I would use is, if you are a very early stage company, you just started your company, you could probably just use LegalZoom for some of your simple legal advices, right? So yeah, if you are an early stage company, yeah, these, software type of, valuation, that's probably okay. Or like when I graduated at UC Irvine in 2002, it's W-2. I could probably just use TurboTax EZ. That satisfies all my needs. But now, now marry, kids, and everything, I, had to get a CPA just because everything is a lot more complicated. And the same thing for, a company that's further along. Very early stage, yeah, I think, Carta is probably okay. But as you continue to make progress, develop new products, have more complicated financial statements, it really helps to have a real valuation firm, because you need someone that's capable of communicating with your auditors or the IRS or the SEC. And as a matter of fact, a lot of times we have clients that, they need to get a new valuation done because the auditor just flat out rejects, the valuation provided by the internet software provider.
Gordon, we've got 6 questions in the chat box. Would now be a good time to take a break and address those 6?
Yeah, sure. Let me go ahead and pull up the chat box too. So, all right. Okay, so first question from Bill. Would you also consider how readily saleable the shares are in determining the value of shares or option provided as compensation? The answer is yes. So because that would have an impact on discount for lack of marketability. If the company is ready to go public or get acquired, then that would imply a lower discount for lack of marketability. So yes, that definitely would have an impact on our analysis. I think this is still from Bill. What is a typical discount rate or range of rates that you would use for the DCF method of company valuation? So I would say that depends, but in general, for earlier stage, it's probably going to be north of 25%, maybe even 30, 40%. It depends on how aggressive the forecast is. But usually for a bigger company that has middle of the road forecast, it's probably 10 to 20%. And if it's a very conservative forecast, it might be as low as, less than 10% actually. All right. And then the next question is from Trin Fan.
Yeah.
Will you send a recording to everyone? So I think Charlotte will go ahead and share the deck and the recording as well.
Yeah, Charlotte typically give her a couple of days, but she usually sends out the recording to everyone who registered for the event in case people registered but were unable to attend.
Yeah.
And then and yeah, we'll definitely provide the slides as well.
Thanks so much, Gordon. That'd be great.
And then where can one find a free Excel 409 template model? I don't know if it's actually free. But there are some cap table providers. So they market the 409 as free, but you actually have to pay for their cap table services. So I don't think it's truly free. So what happens is, these cap table providers, they make money on their cap table, but they do the 409 for free. But it's really not free because you're paying for a cap table.
Gordon, thank you so much for presenting this. I'd actually reached out to Cabrillo and arranged for this, so apologies for being late.
No
but
problem.
really appreciate this. As a CFO, this is something we do every year and always much topic of conversation with the board. One question I had is typically when we have a 498, it's good for a year unless some unusual event happens before that. But let's say it expires on June 30th. Typically, we would do the June 30th financials. So sometime in late July, we would turn over the financials. And based on that, there'd be a 490 evaluation done. And it might take a month or two. So we'd get the June 30th effective valuation, but a month or two later. And
That's
so
right.
during that month or two period, we can't issue options because there's no strike price. But as I've talked to Cabrillo advisors and others, my understanding is we could actually do it earlier. So for example, we could provide forecasts for June 30th and beyond today, and the team could work on it. And so we could actually get a June 30th effective 49A sometime around June 30th. So we wouldn't have a gap period. Is that right?
That's exactly right. So as a matter of fact, a lot of times we have companies, usually bigger companies, they just need to continue to issue options and have employees, right? So in that case, we would just use whatever they are able to provide. So so for June 30th financial valuation day, maybe we'll have April or May financial statements. And that's actually okay. Keep in mind, we rely on public company data. Public company data, they also trade on financial statements that's a month or two behind, right?
Mm-hmm.
So it's actually okay to not have June 30th financial statements for June 30th valuation dates. So that's definitely not a problem. So we will work with our clients closely if that's something they need. And that's when I say, sometimes clients, they just, they need it right away. So we'll, if we have to, we could get it done within a week. Or if we work closely enough, then we could actually issue the June 30th valuation on July 1st. It's usually at least a day behind because we do need the inputs.
Got it.
And then there's a lot more question from Nicolau. So what is the fee range for a 409 valuation for a small growth company under 5 years of existence? So our 409, we usually start at about $6,500. And if it's really straightforward, very, no revenue, just simple cost approach, then sometimes we'll be able to do it for a little bit less. But usually it starts around 6,500. And then if the company is more mature, approaching an IPO, then it does get more expensive because you do have to deal with audit scrutiny. So especially right before an IPO, then we're not talking about just auditors. We're also talking about SEC, that will eventually need to review the 409A. Thank you very much for these questions. So I'll go ahead and continue. I think I have a few more slides only.
Yep.
Yeah, so I think I already talked about, what kind of valuation we do, but just to quickly summarize, so we'll do business valuation for pretty much everything. Oh, and if I could just quickly add, going back to the 409A, so sometimes, we have clients that, they just get some, pitch deck from investment banks, but keep in mind, sometimes, these investment banks or some, smaller valuation companies, they do valuation for an entire company. They are not actually valuing the per share price, and they're not as familiar with DLOM, they're not as familiar with different classes of securities. So that's why it's important to have someone that has the experience for these 409A, and especially at the end of the day, you want to take advantage of the DLOM and as well as the liquidation preference, which would tend to lower the per share value of the 409A. So that would be, definitely a huge benefit. But yeah, just, in addition to 409A, we'll do purchase price allocation, complex securities, especially for private companies, sometimes they'll issue convertible notes, and these convertible notes, they'll usually have warrants attached to them, and they convert into the next round. So sometimes auditors, they want these to be valued, and we do need to use more complicated methods. So that would be Monte Carlo simulation, lattice model. And those gets very complicated, so I don't want to talk about those here. But again, we definitely have the ability to value complex securities as well. I talked about IP transfer. We do dispute resolution. Sometimes we have shareholders that want to exit. We can do that. Fairness opinions, solvency opinions, and estate planning type of valuation. Yeah, here are just some of the fun companies that we've worked with. Again, because of our location in San Diego, we do tend to have a lot of life sciences clients. And these life sciences companies, the funny thing with these is you don't even need to have revenue to have huge market cap. A lot of these life sciences companies, they are only phase 1 or phase 2 companies. They don't even have FDA approval, and they are still worth billions. So it's definitely a very different type of valuation methodology. Just some of the transactions that we've worked on. Again, industry agnostic. We have life sciences here. This is real estate, private equity, engineering, and this cannabis.
Gordon,
yeah.
can I ask a question? The life science is a good example. They can have a huge range of outcomes, right? If they get FDA approval, it can be worth a lot. If they get no FDA approval, the company's worthless, essentially. If I remember right, I've seen where it's sort of a weighted average of scenarios. So you might do 2 scenarios, one where the company goes public and one where the company goes bankrupt, and assign
Yeah.
probably is.
That's definitely one way to do it. And a lot of times we use what's called an RNPV, risk-adjusted NPV method. So it's just a very complicated DCF method. So in addition to applying a discount rates to the cash flows, we also apply a probability of success. So for example, usually the probability of a company moving from phase 1 to phase 2 is 30%. From phase 2 to phase 3 study is 50%. From phase 3 to NDA is probably 80-90%, and NDA to FDA another 90%. So the cumulative probability of success from a phase 1 to FDA approval is only 10%. So we would apply that probability in addition to applying a discount rate. And that's how we would look at it. And every disease area is different. So cancer has the lowest probability, or one of the lowest, versus maybe some other disease. And then there's other, additional considerations for example, rare diseases. They get fast track, so they'll get reviewed by the FDA within 2 years. So it definitely gets a lot more complicated. So again, it's just something we are also familiar with, just in case anyone's life sciences space.
The reason I brought it up is I think this exercise of 409A is very different than what evaluation one might do, for example, for raising equity. Typically, when companies are trying to raise equity, they're trying to give their best case scenario.
That's right.
Not maybe their expected case, but their high case.
Yeah.
When they're doing the 409A, you want to factor in all the different scenarios. So this valuation 409A generally should be much lower then
Yeah,
typical investment.
exactly. Exactly. So 409, it's not for equity raise. So when you raise an equity, you want to put your best foot forward. But 409, it should just be realistic. We want to see, some type of realistic, forecast, real risks that you face. And then we need to consider the liquidation preference or the discount velocity marketability. Whereas when you're raising equity, usually when people talk about, oh, hey, my company is worth, $100 million, they are actually not distinguishing preferred versus common.
Right.
When everyone knows preferred is worth a lot more. So, but hey, we're just gonna take the per share value of a preferred and multiply it by the total shares outstanding. So definitely very different type of valuation. And by the way, we do that type of valuation too. So sometimes companies want to raise equity. Then you want to put the best foot forward, and we'll still need to be able to support it. But yeah, it's definitely a different type of valuation.
Yeah, and I think the other consideration I've seen sometimes is whether you're looking at a controlling interest or non-controlling interest. So if you sell the whole company and someone comes in with the controlling, and then they might pay a higher price. But if you're looking at small pieces of the company, the minority investor is going to pay less.
Exactly. So there's very clear market evidence of control premium. So whenever we see an acquisition from someone, there's usually going to be some type of control premium. So for example, years ago when Louis Vuitton acquired Tiffany, they had to pay a significant control premium. They then tried to backtrack because of COVID, but that's a different story. But just whenever you see an offer on a table, there's always going to be some type of control premium. So yeah. And as a matter of fact, when you value a minority share, then that's when you have to go back and apply discount for lack of control and discount for lack of marketability. So there are and then sometimes there's voting versus non-voting. Then there's going to be some non-voting discount as well. So there's definitely a lot of many different discounts. But yeah, thank you very much for the question. Again, just some of the fun jobs that we've worked on. Again, we're very industry agnostic, pretty much every industry. So I talked about some of these companies. Cannabis, it's always interesting. I'm not sure if we have any cannabis CFO here, but they're definitely a different breed. We've helped Fatburger. If you are in the US, you probably recognize Fatburger, DraftKings, some of the local life sciences companies in La Jolla. But yeah, that's actually it. So I think there are a few more questions, so I'll go ahead and pull those up and answer the questions. Let's see. Okay, so the CCC, that's the person's name. Do audits typically require an independent valuation, or can one provided by management suffice if done properly and supported? Practically speaking, would you even ever really want to do internally? So no, it really needs to be done by a third party valuation firm. And in reality, sometimes companies, very early stage company, they'll just say that, oh, the company is worth what I'm putting in. And because it's so early stage, the audit screening is, kind of non-existent. So yeah, maybe that you'll get away with it. But in reality, you do need a third-party evaluation provider. Because again, if you do the evaluation yourself, I mean, that's just, massive conflict of interest, right? So, you are supposed to get a third-party evaluation firm. All right, another question from Trin Fan. If the 409A value expires in March of 2024, employees exercise in May of 2024, then the new 409A value is not approved by the BOD until June 2024. What strike price should we use for the 3921 form to the government? Okay, so if the 409 value expires in March of 2024, then, but if the employees already has the options, then that means their strike price of the options that they received, that'll never change. So if they received the option 5 years ago at a per share dollar value, then that's the strike price, even if the company is worth a lot more now.
I think they're asking if they grant new options.
Okay, yeah. So if you grant new options, then yeah, you'll need a new 409. So if it expired in March, then if you want to issue new options in April or May, yeah, then you need a new 409. So sometimes we have companies, they just don't, have the bandwidth to do a new 409 because of, activities. And in that case, we would frankly just recommend that they don't issue options for a while, because otherwise you're not going to be able to satisfy the 409 requirement, and you just don't want to risk it, to be honest, because there could be real tax consequences for the employee if your valuation continues to go up but you issue options at the prior strike price. Back to the timing question from Jonathan. Back to the timing discussion. If we do rolling option issuance between financing rounds, do we need to submit financials to feed your model on a rolling basis so we can true up interim valuations? I want to make sure I understood that correctly. So in between, yes. So short answer is yes, we want the latest available financial statements. It doesn't have to be so let's say, again, going back to the June 30th valuation, we don't need June 30th financial statements, but we also cannot rely on, say, December 31st. We need at least financial statements that's somewhat current. I would say if it's a month or two behind, then that's fine. But if we're 3-4 months behind, then that could be an issue. So we do want financial statements that are as current as possible.
Can I just clarify, Gordon? So if Cabrillo Advisors does a valuation as of June 30th, typically that's good until June 30th next year.
That's
So
right.
if you issue options between June 30th this year and next year, you can use that 498 number. So you don't have to constantly refresh it. I think that may be the confusion here.
Got it. That's right. Unless there's significant milestones or events that would impact the valuation itself. All right. Can you share what are the main differences of valuing real estate companies versus companies in other industries? So if it's a real estate, investment companies, obviously you want to look at comparable companies in that industry, and also real estate companies. It's very broad, right? So maybe we're also talking about real estate construction versus real estate private equity, but we want to make sure we capture the correct comparable companies. So, for example, real estate construction companies, they tend to carry a lot of debt. So that's something we really need to make sure we adjust, is the working capital. So how much of the working capital is really debt versus, just working capital for a retail company. And then construction company, they also have very different CapEx requirements. So all these are something we definitely need to make sure we capture. And yeah, just other industry, every industry is different. Just like I said, life sciences, very different type of DCF versus retail versus manufacturing or aerospace. And what is the fee range for a fund raise valuation? So that usually we set a range, and that usually starts at $7,000 and maybe $10,000-$12,000. And it's usually a range because usually it's a lot of back and forth. Sometimes we'll come up with a range, and then management might feel that, hey, actually we forgot these few items that we want to try to capture. And we definitely work with our clients to make sure, we get to a reasonable range. And a lot of times it's almost like a consulting project. We have clients that give us a forecast. They just want the biggest valuation possible, right? And they have a forecast that with growth that exceeds the entire industry. And like that just doesn't make sense. So we are essentially a consultant. We help and guide them to come up with something that just makes more sense.
Hey, Gordon, can
Yeah.
I follow up on that question, on that statement you just made, because it was something I was curious of. What are some, obviously, to your point, management may have an interest for a valuation that is skewed in one direction or another, depending on different motivation. What are some of the levers that management can use when working with you to help you in guiding the valuation in a particular direction?
Sure. So the forecast is definitely something that'll have an impact, right? But we also don't want just something that's made up, and because frankly, we'll see through it too, and investors they'll see through it. You definitely want some backup numbers. So, for example, if you are showing you have a history of doing 20-30% forecast, and all of a sudden you're forecasting 80-90% growth, honestly, it just doesn't make sense. Sure, we can still use it, but I'll be honest with you. I'll tell you that investors, they're probably not going to believe your forecast. And again, going back to the forecast is also just understanding the customer base. Do you really have these contracts in hand? If you do, that'll definitely make a huge difference versus you're just coming up with random numbers to have a huge number. And on the other token, so if it's for estate planning, gifting type of transaction, then usually we want, the lowest indication possible. But again, it still needs to make sense. If you continue to grow 20% per year, and all of a sudden for this gifting valuation, you're showing 5% growth, and there's real audit scrutiny here about IRS. And, if we feel we have to, we'll definitely will, let you know too, because at the end of the day, you don't want to be picked up by the IRS for audit and then end up having all these penalties that you have to deal with. So what I'll say is usually valuation is very subjective. Usually there's a range, and as long as it makes sense, we could be, go to the higher end of the range or the lower end of the range, but at the end of the day, it should stay within the range. Just because, again, if you have something that doesn't make sense, then it's not going to help you if investors don't believe it either, right? We have a couple more questions. Did I answer your question, by the way?
Yes, you did. Thank you.
Great. And then Ken has a question. How is convertible debt with a cap factor into a valuation if the debt is close to maturity and the cap is higher than the last 409A? The reality is the cap really doesn't impact our analysis. The cap is just a way to protect the company. So in reality, it doesn't, in terms of the business valuation itself, it doesn't really impact us. It might impact the per share value because in a new raise, the convertible notes is capped at the price, right? So if the company is worth a lot more than the cap, then it would have a smaller dilutive impact. So, but at the end of the day, when we value a company, that cap, it impacts the dilution of cap table, but in terms of the valuation itself, it doesn't really impact our analysis because we're just looking at current market data, current multiple, current discount rates. William, Bill, any tips on ways to get capital gains treatment at time of sale for shadow equity? I think this is more of a tax accountant, tax attorney type of question. I just want to be very careful because I'm not a CPA. I'm not a tax attorney, so I don't want to, these are not the type of advice that we should be giving. But tax attorney would definitely be able to assist you with that. How do you select the comparable companies in the market value approach for private companies? That is subjective. So there's never going to be a perfect set of comps. Let's say, we have a company, client in the cell phone space. So your comparable company would be Google, Apple, Samsung. But in reality, those companies, they are so diversified, right? Apple has everything, Google has everything, but you have one private company that's only cell phone. So there's definitely always going to be, a lot of thoughts that we want to put in selecting comps, but there's never going to be a perfect set of comps. And that's why we make sure we adjust for, the size, we adjust for the growth, because usually a private company is going to be much smaller and it's just going to have a small multiple. You're not going to get, just because you are also in the phone space, doesn't mean you'll get Apple's multiple, right? And that's why we also want to complement it with, other valuation approaches like the income approach. But yes, in general, you're not going to find a perfect set of comps, and everyone understands, that's just the case. But we definitely do our best. So we talk with the management team. We do a very thorough search of comparable companies to try to pick the best comps. All right.
Well, thank you, Gordon. Susie, I think Gordon was your guest, actually. Is there anything you want to say in the way of concluding this segment?
This was fantastic. Ronnie, is there a question? I see a hand up still. I don't know if we answered it already.
Hi. No, thank you. Thank you for all the information. Super helpful. I just want to ask Gordon, he mentioned, in addition to the 409 valuations, there are also, they also do equity raises valuations. And I was wondering if he could mention, at the beginning, he basically went over the different, methodologies that he used for 409, and, pretty similar in terms of the asset methodology, market, and DCFs. But I was wondering specifically, so when you are thinking about, valuation a new company that doesn't have any history, and then you're, trying to do this equity valuation, in addition to the, best case scenario in terms of revenue and expenses and margins, what else is important to think through, and what are maybe the do and don'ts that you guys as experts utilize when trying to curate this type of valuations?
So did you say it's for early stage pre-revenue company?
That's correct.
Okay. So yeah, for early stage company, if it's for fundraising purposes, then usually you want the highest valuation possible, right?
Correct.
So in this case, we'll definitely want you to have a set of forecast, but we also want the forecast to be reasonable. Just because if you have pre-revenue and you forecast, billions of revenue, I mean, everyone can put together a forecast that shows huge growth and huge EBITDA, right? But it's not going to make sense if it's not reasonable. So, but we would definitely want a forecast, and we can help you to develop the forecast. As a matter of fact, that's what we do a lot for a lot of life sciences companies is, life sciences companies, the clinical ones that essentially none of them are revenue generating, just a bunch of expenses for the next 5-10 years. So in that case, we'll just need to help, them with the forecast, and we'll look at comparable companies in a space, and then we'll look at their EBITDA margin. So if the entire industry has a EBITDA margin of 10%, yeah, that's where you should be at. I mean, we'll always have clients that tell us, oh yeah, we're different, we're lean, and we'll be at 20-25%. Maybe for a year or two, but if you are at 25% when everyone else is at 10%, other people are going to go into your market and try to take some of your profit margin. So that again, then that almost becomes a consulting type of project. Then we, show you, hey, these are your comparable companies. These are the kind of working capital that they have. This is how much they spend in terms of CapEx per year, and this is their profitability. And these are why you probably should fall within these range. Sure, you might try to be optimistic and be at the higher end of the range, but you still want to be at the range. And depending on industry, sometimes we'll use what's called a market value of invested capital, especially for the tech space. So a lot of maybe AI companies or tech companies, they are not generating meaningful revenue. And a lot of it is actually just a multiple of their invested capital. So